Good morning. What historic times we live in. We live in a time that your children will read about and their children will read about, and it's a mess we created. We did this. I hope today to share with you some thoughts on how we get out of this deep, dark forest. I entitled my remarks, Breadcrumbs Back Through the Forest, because the way out is probably as difficult as the way in. Everybody's searching for that way out. But what I thought I'd do this morning is spend a few moments with you to perhaps cast this in a way that will help you help your own institutions as you make credit policies and move things forward from here over the course of the next 24 months. Today we're going to talk about tulips in crisis, smart people. We're going to talk briefly about the dodo bird, used cars and home loans, the albatross, Isle of Paris in the springtime, illiquidity, barbecue wisdom, and flipping on the headlights. Let's start here in Las Vegas, Nevada, fall of 2005. I was speaking to the Western Regional Mortgage Brokers, and I had a room full of loan originators listening to me talk about credit quality and stated income loans. And I was particularly incensed about an article I just read in the Los Angeles Times that profiled two restaurant workers who just went in together to buy a starter home, and they wanted to get in before they were, quote, priced out of the market. And I came up out of my chair on a Sunday morning, and I thought, two restaurant workers. I know restaurant workers. I've got 20-year-old children. They aren't qualified to be purchasing a $500,000 full 100% LTV home. But that's what they did. They went in together before they were, quote, priced out. And I thought, well, two restaurant workers were priced out at 110, 120, maybe 130, but 200 was out of the question, 300 was ridiculous, and 500 was just nonsensical. Why didn't they just move waterfront Malibu? Then I had a neighbor, second story. Well, these are going to form the foundation of my remarks today. A neighbor who is a realtor and who sold a home in the summer of 2005. I said, how's the market? She said, it's fine. I just sold a house, she said. Good. Who'd you sell it to? Woman coming out of a marriage, recently divorced, had $80,000, single mom, waitress, $440,000. And I said, really? Yeah, she got a $360,000 loan, and I'm so happy to have helped her into her own place with her children. Here you've got a realtor who thought she was helping someone accomplish the American dream. And all I could see was a woman buried in debt, a woman just out of a marriage with $80,000 and a little liquidity, a little money for when that transmission blows up or one of her children gets sick. She just sunk into a property, and she's $250,000 or more in debt. But the real estate industry said that we're helping people. I identified this way back as a real problem and an unsustainable economic model. But let's talk about unsustainable economic models. In the 1630s, in the Netherlands, there was a tulip crisis. Tulips went through the roof. If you can imagine such a thing, everyone in the Netherlands thought the tulips would just do nothing but go up in value. And so people bought tulips today, thinking they could sell them tomorrow for more. And they did for a period of years, until in 1637 the highest price paid for a tulip was 40 times the average wage of a person living in the Netherlands. 40 times the average wage. And one day they woke up and they said, it's just a tulip, and the market crashed. There was nothing there. They were simply flowers. Today, certainly in California and in Florida and in Las Vegas and in Phoenix, people are waking up and saying, it's just real estate. Now, let's talk about smart people for a moment. We have plenty of them in the mortgage industry, and in the post-war era, we've spent the last 60 years figuring out exactly, as my father would say to a gnat's eyebrow, who's going to pay you back and who's not. We've fiddled around with front-end and back-end ratios, job stability, cash, credit, debts, employment, income, owner occupancy, all the variables. lenders figured out exactly who is going to pay you back and who's not. What would cause smart people to abandon everything they knew about solid credit quality? What would get smart people to say, I'll not require income verification anymore. I won't require skin in the game. There's no more down payment requirements. Greed. I feel like that Kevin Nealon character on Saturday Night Live, Mr. Subliminal, who between every other sentence would say what he was really greed. Thinking greed. To get us as an industry to collectively abandon everything we knew required that people simply be greedy. Let's talk about the dodo bird. Sometime in the 1680s, about 600 miles off the eastern coast of Africa, the last dodo bird was stomped to death or kicked to death or chased to death by some sailor's dog. The dodo bird, I'm a student of natural history. I love science, I love natural history. It actually takes up quite a bit of my time. One writer wrote about the dodo bird that the bird was spectacularly short on insight. The dodo bird, if you killed his friend, would stand there and look at you and wait for his fate. They had no inclination to run. They had no sense of danger. They had evolved over the course of several million years on this island without any predators whatsoever. In fact, they'd lost their ability to fly. Spectacularly short on insight. And you know, as a lawyer, I'm always looking for terms to insult people without getting sued. So I've found my phrase, spectacularly short on insight. We in the mortgage industry have been spectacularly short on insight with these stated income loans. I'm going to give you some examples. Bloomberg, third quarter results, countrywide announces third quarter loss of $1.2 billion on their loans at the end of the third quarter 2007. Analysts were expecting a $200 million loss. So their loss is about 6 times what's expected. And what happened to their stock that day? Shares jumped $4.23, or 32.4%, to close at $17.30 when Chairman Angelo Mazzillo said, "We continue to be bullish about the long-term prospects of both Countrywide and our industry." And I will note, and not parenthetically, that this is the same month in which he was selling 500,000 shares of his company. From Bloomberg, IndyMac Bank. Shares of companies that offer less risky mortgages, including IndyMac, have fallen this year, partly because investors were concerned Alt-A loans may go sour. Regulators, including Federal Reserve Chairman Ben Bernanke, said they don't see any spillover of defaults into safer mortgages. And IndyMac said today the industry's loss rate on Alt-A is 1/7 of the level of subprime loans. The contagion isn't that big a problem. I don't see the risk as being that significant. Let's talk about Mortgage Bankers Association, of which I am a $2,500 a year dues-paying member. On March 27, 2007, the Mortgage Bankers Association, in front of Congress, said rigid new underwriting standards, no matter how well-intentioned, aren't in the public's best interest. And then the great phrase, the magic of today's market is that the widest range of borrowers can get the widest spectrum of loans. I would suggest to you that if you are testifying before Congress, that you try not to be so spectacularly short of insight as what the MBA came up with under oath and in front of Senator Dodd.